Here's our April preliminary read on durable good orders. Expected up 0.6, a miss up 0.4%, sequentially, at least for the moment, following up 1.1. If we strip out transportation, there's slight deterioration, up 0.3, half of expectations. And, well, it's a third of our last look at up 1.4. Actually, it's more like a fifth of our last look at 1.4. And if we look at capital goods orders, non-defense ex-aircraft, a proxy for capital investment, expected up 0.5%, up 0.3%. And if we look at shipments versus orders, also up, expected up 0.5%. It's the only component that's better than expected, up 0.8% on the shipments, and that's double the rate, at least thus far, of last month's final look at up 0.4. So these numbers are close to expectations, a bit of a miss. We know that Empire, Philly, we've seen some misses there on new orders, so it's interesting to see the shipments is better. We do see some of the changes coming in from last month, and they're not very notable, except for we do see the headline last month moving from 1.1, now revised to half that at up 0.6. Interest rates continue to deteriorate because the equity market's volatility and some of the misses that we've seen in earnings really taking a dent out of the psyche of investors. We all understand that the Fed is on a mission, but there's a lot of central banks on a mission, and that whole fungible tightening cycle that's going on is really taking the air out of a lot of equity markets and begging the question to be answered that how are all these interest rate hikes going to cure some of the ills in the economy, even with what's going on in interest rates. The likes of Goldman Sachs and Bank of America still see housing prices up anywhere from 10 to 15% this year. Ponder that. Joe, back to you.
So many different cross currents, Rick. The supply of houses is, people are still going to buy them. It's never been like this before, where it's sort of inelastic, isn't it? Rates can go up, prices can go up, and people are still going to show up if they want to buy a house, and there aren't any around.
Yeah, it's amazing, Joe. Anecdotal for sure, but I have some relatives that have been looking for houses, and you go to these open houses, and it's like a convention. There's a big crowd, and these crowds still remain. Now, granted, we've seen various aspects in cottage industries of housing, from originators to builders, taking it on the chin. But I still say, when you're looking for housing prices to go up in this environment, it really is a one-off, not to mention all the other issues with food and export restrictions, and, of course, passing legislation that ultimately could lead to price controls. None of these are going to solve the issues in front of us, Joe.
Oh, okay, Rick. Thank you. Appreciate it. Steve, it says Steve Leisman joins us with data now, or on the data. That's when I always see Lease Mania instead of Leisman data. So that's where it comes from, but they were out there already, the maniacs.
Yeah, screaming and really running amok through the streets there. If you get a wide shot of behind you, Joe, I'm sure that it's just going crazy
right,
back
they're
there.
Excited
Look,
for
I want
to
do two things. I don't know if Rick can stick around. I want to get the rates in just a second, but I do want to point out this number is pretty good, and I'll tell you why. There was a miss. If there was a miss in terms of what was expected by economists here, I think it came from the motor vehicles and parts, which was down 0.2, but we do have a rebound right now in terms of purchases of vehicles, especially at the corporate level. And that should have shown up, but it didn't. It may show up next month. So I'm not sure. There's this incongruity between when the government reports and what's actually going on and some of the private sector data on the autos. So I don't really see this as a miss. And I think more importantly, Rick emphasized this issue of what's happening with business spending. I don't know that we have a chart in the back, but what I want to show you is that companies have an awful lot of money, Joe, and they're putting it to work. They had spending that was delayed from the pandemic. They also had stuff that's wearing out. They've also had difficulty finding stuff. And so according to a recent report I read, there's about $1 trillion of excess money out there relative to where the trend was before the pandemic. And companies are putting that money to use. They may be doing it through buybacks. They may be doing it through dividends. But more importantly, they're going to be doing it through capital spending. I think that's good for the outlook for the economy. That's one thing that may not be deterred by this concern, come down a little bit from a recession. The other thing I want to talk about, Joe, is what Rick mentioned, which was how profoundly the outlook for rates has changed. I want to show you two things. First of all, I want to show you the outlook for 50 basis point rate hikes. What's happened is you got a 90% plus chance for a 50 in June, 90% chance plus for a 96 in July. But look at what happens to September. Now the odds-on bet is for a quarter point. This idea of hike, and then kind of slow is what's being built into the market. And then very quickly, I talked about this in the 7 o'clock hour. If you take a look at the next chart, what you'll see is that there's an expectation of an ease built in. There's that. Look at that December 23 contract, 275. There's your terminal rate, 290-ish around July 23. But that 290 number as a terminal rate has come down, Joe, 50 basis points. We have had a profound move in just the past several weeks in the outlook for the Federal Reserve.